Welcome back to the Deep Dive. We're the place where we try to cut through all the noise and really get straight to the insights you need. We look at these fascinating, sometimes frankly alarming events that are shaping our world.
That's right.
And today, we are plunging headfirst into a story that just perfectly encapsulates this wild, often unpredictable intersection of celebrity culture and, well, the incredibly volatile world of cryptocurrency.
It really does.
We're going to dissect the sudden, high-profile launch of Kanye West's or YZY Memecoin. This happened on the Solana blockchain, and it was followed by an even more sudden, absolutely catastrophic crash.
Yeah, catastrophic is the word for it.
Our mission with this deep dive, it's crystal clear. We are going to peel back all those layers of, frankly, blinding hype that surrounded the YZY token.
Right.
We want to meticulously understand the underlying mechanics, not just what fueled its astonishing meteoric rise, but maybe more critically, what inevitably led to its spectacular collapse.
Right, the why behind it all.
Exactly. And most importantly, for you, our incredibly curious and engaged listener, we're here to extract crucial, maybe actionable lessons. For anyone navigating this incredibly high-stakes, high-volatility world of celebrity-backed crypto assets.
Yeah, definitely some lessons to be learned here.
By the end of this conversation, you're not just going to be informed, you're going to be incredibly well-versed in the nuances of this truly fascinating and, like I said, alarming event. And when I say alarming, I mean it in the starkest terms. We're talking about a digital asset that, in just a dizzying display of speculative frenzy, unchecked enthusiasm, it briefly surged to a staggering $3 billion market cap.
$3 billion, it's almost hard to fathom.
Just imagine that billions of dollars of value conjured seemingly out of thin air, all tied to a new token. But then, in an equally breathtaking reversal, it plummeted over 90% within just a matter of hours.
Yeah, hours. Not days or weeks, hours.
This wasn't some slow, drawn-out decline. This was an explosive launch immediately followed by an almost instantaneous, brutal implosion, the kind of event that leaves a trail of, well, financial devastation and a lot of very important questions in its wake.
Absolutely. A lot to unpack.
So let's jump right into the heart of it. This wasn't just a crash. It was a flash launch followed by a flash crash. It all happened with such incredible velocity. Can you maybe walk us through that exhilarating yet terrifying meteoric rise and then the almost immediate, equally dramatic fall of YZY? What'd that timeline look like?
Yeah, the velocity is really the key thing here. It's what makes this so captivating and, like you said, alarming. Kanye West, or Ye, he didn't do a pre-announcement. There wasn't a build-up, no traditional marketing campaign.
Right, none of that.
No. Instead, he quite literally suddenly launched the YZY Memecoin on Solana. It was almost like it appeared out of nowhere. No white paper to study, no detailed roadmap for utility. Just boom, it was there. Instant eruption. And that unexpectedness, combined with, the immense star power and the often controversial allure of Ye, it immediately sparked what our sources vividly describe as massive hype. It wasn't just excitement. It was a speculative fever pitch. People were driven purely by that celebrity association, the fear of missing out, FOMO and maybe the dream of quick, life-changing riches. They rushed in with astonishing speed.
Unbelievable speed.
And the token, within an incredibly short time frame, rocketed to that astounding $3 billion market cap. Now, let's just pause and truly consider that figure for a moment.
Right.
$3 billion. Concentrated in a brand new, unproven digital asset propelled mainly by the strength of a single famous name.
It's just mind-boggling.
It really is. It's a powerful, almost unbelievable testament to the sheer gravitational pull of celebrity influence in these nascent, often unregulated markets. This kind of value accumulation, driven almost entirely by speculation rather than any real utility or technology, it's a hallmark of the meme coin thing, but YZY really pushed it to an extreme. The psychology there is fascinating, right? It bypasses that rational decision-making, taps directly into the excitement, the collective belief that a famous person can just conjure value into existence.
Absolutely. It's almost bewildering to wrap your head around that kind of exponential growth, that immense value appearing seemingly out of nowhere, fueled by what you rightly call pure speculation. The sheer psychological pull of a name like Ye is undeniable.
Definitely.
But as quickly and dramatically as it rose, the token plummeted just as fast. So what was the devastating aftermath for those who bought into that initial wave, those who got swept up in the promise of those rapid gains?
Well, the swift decline was, if anything, even more dramatic and certainly more brutal than the rise, especially for the average retail investor. Our sources say the token plummeted over 90% within hours.
90%.
In hours. Just picture the stark, gut-wrenching reality of that. For anyone who bought in near the absolute peak, maybe putting in a significant chunk of their savings, 1 minute they're sitting on what looks like a rocket ship, dreaming of huge gains, paying off the mortgage, whatever.
Yeah.
Life-changing money.
Exactly. The next, virtually all of that value, a staggering 90% or more, has just evaporated. Gone. Into thin air.
Oof.
And this wasn't a gradual correction. It was a sudden, violent market crash, often called a rug pull or a pump and dump when insiders are involved, which, spoiler alert, seems likely here.
We'll get to that.
Yeah. The unique brutality of this kind of rapid value destruction in crypto is amplified because the market's 24/7, right? There's no closing bell to pause the carnage. For those caught in it, it's just absolutely brutal, often financially ruinous. If we connect this back for you, our listener, it highlights the extreme fragility and the dangers of tokens that lack any fundamental utility, robust tech, or real use case. Tokens propped up entirely by fleeting speculative hype.
Wow.
Imagine the emotional whiplash, the despair for anyone who bought YZY during that brief, euphoric window, only to see their investment just decimated, just as quickly, often before they even had a chance to react. It's a potent, incredibly expensive reminder of the risks, the often hidden risks, in this part of the market.
That's a truly harrowing image, that emotional and financial roller coaster, losing 90% in hours.
Okay, let's unpack this then. How could a token lose so much value so quickly? It almost feels like something was fundamentally flawed, structurally imbalanced, right from the very start, almost like it was designed to fail for most people.
That's exactly it.
What does the on-chain data, the ultimate proof teller in crypto, tell us about the initial supply concentration of YZY?
You've hit on precisely the core issue. And the on-chain data paints a very clear and frankly damning picture. The data reveals this critical, almost insurmountable flaw, a structural imbalance that practically preordained the crash. It ensured wealth transfer, not genuine market participation.
Okay.
A shocking 94% of tokens were held by insiders.
94%.
94. Let's pause on that number for a second. It's not just a number. It's like a death knell for any pretense of a fair market. Imagine buying shares in a public company where 94% of the stock is locked away, controlled entirely by the founders and their inner circle.
Right, you own almost nothing. Exactly. You, as a public investor, are buying a tiny, almost irrelevant fraction, just 6% of the total supply. What does that mean for price discovery? It means there is no real price discovery. The market isn't driven by diverse supply and demand.
It's controlled.
It's entirely at the mercy of that 94% held by insiders. They can, with minimal effort, drive the price up with small trades, create artificial scarcity, build hype, because they know they hold almost all the cards.
And then they can dump it.
And then, when the time is right, they can unleash that overwhelming supply onto the market, drowning any retail demand, crashing the price instantly. It's not just a red flag. It's like an entire field of red flags waving frantically from day one. Structural risk baked in.
That 94% figure is absolutely astounding. It feels less like a market and more like a private club, as you said. But it gets even more specific than just insiders generally, doesn't it? Our sources point to immense power concentrated in one particular entity.
Precisely. Digging deeper into the on-chain forensics, the reality gets even starker. One multi-sig wallet alone controlled an astonishing 87% of the total YZY supply.
87% in one wallet. Even a multisig.
Exactly. Now, for our listeners, a multi-sig wallet, multi-signature, needs multiple keys or signatures to authorize a transaction. Usually, the idea is to enhance security or governance, right? Distribute control, prevent a single point of failure, like a company treasury might use one, or a DAO.
It's supposed to be safer.
It's designed as a safeguard, a distributed control method. However, in this context, when a colossal 87% of the entire supply is in one such wallet, even if it needs, say, 3 out of 5 people to sign off, it still means immense centralized control.
So a very small group held all the power.
A small, predefined group had almost total, unchallengeable power over the token's market dynamics. Compare it again to that company. 94% held by the board, and one tiny committee controls 87% of those shares. The public owns next to nothing, has no say, no real chance for participation.
It creates an illusion.
Completely. An illusion of a decentralized, fair market, while in reality it's highly centralized and easily manipulable. The very mechanism meant for security was flipped here, leveraged for absolute control. A potential safeguard became a tool for market dominance.
So, with that kind of iron grip on the supply by such a small group, what about the actual trading mechanism? The liquidity pool, where regular investors are supposed to buy and sell freely, how is that configured? This seems like another critical piece.
Indeed, another critical and deeply problematic piece. It directly facilitated the insider activity and the eventual rug pull. The liquidity pool for YZY was set up in a highly unusual way. It was a single-sided YZY pool with no USDC pairing.
Okay, break that down. Why is no USDC pairing so significant?
Right. So normally in a healthy liquidity pool in DeFi, you'd pair a volatile asset like YZY with a stablecoin USDC, USDT, DAI, something stable. This does several vital things. Provides balanced liquidity, lets new investors easily buy YZY with stablecoins, and lets holders easily sell YZY for stablecoins. It's a clear, stable exit path, like a currency exchange booth.
Makes sense. Two-way street.
Exactly. But a single-sided YZY pool with no USDC pairing, that fundamentally changes things in a really bad way. It means there's no direct, stable way for new investors to buy in easily with stablecoins or for holders to reliably cash out to a stable asset within the pool itself.
Ah, so the exit is tricky.
Very tricky. Our sources explicitly state this setup enabled insiders to manipulate liquidity and exit rapidly. Think about it. New money, maybe in the form of Solana or other cryptos, flows into the pool to buy YZY, but there's no balanced way for those investors to convert their YZY back out into a stablecoin within that same pool.
So the money gets trapped.
Essentially. Insiders holding that massive 94% supply could just dump their YZY onto these new buyers, collecting the valuable Solana or whatever else came in. Meanwhile, the new buyers are stuck holding this highly illiquid YZY that they can't easily swap for stable value.
Wow.
It facilitated a rapid extraction of value by insiders, leaving retail holding the depreciating bag. It's a game with rigged rules designed for swift profit extraction, not fair exchange.
It sounds incredibly skewed from the start. A market designed for a select few. Now, our sources also mention these supposed anti-sniping methods, deploying 25 identical contracts, only one randomly activated. On the surface, that sounds kind of clever, maybe sophisticated. Like preventing bots from getting an unfair advantage at launch.
Right, it sounds sophisticated.
Was this genuinely designed to be fair, or was it just another layer of misdirection? A veil over the real intentions?
This raises that crucial question of intent versus outcome. And in YZY's case, the evidence strongly suggests misdirection. While those anti-sniping methods might sound like a way to ensure a fair launch, prevent front-running, the reality painted by the on-chain data tells a very different, much darker story.
Okay.
Despite these supposed technical safeguards, the bottom line is insiders still got early access. So whatever mechanisms were there, they were either totally ineffective against sophisticated insider tactics, or maybe more plausibly, they were just a smokescreen.
Just for show.
Yeah, to give the appearance of fairness and tech sophistication while the real game is happening behind the scenes, ensuring preferential access for those running the show.
Do we have proof of that insider access?
Oh, absolutely. Concrete, irrefutable examples. On-chain analysis shows wallets linked to insiders buying massive amounts of YZY right at launch. For instance, one wallet got about 1.29 million YZY for roughly $450,000 in USDC.
Wow, that's not retail buying.
Not at all. These were big, pre-planned buys executed perfectly right at the start, suggests privileged info, privileged access, and what happened next. These same insiders exited quickly, booking over $1.5 million in profits.
Unbelievable.
They sold into the hype, capitalized on the rising price fueled by new retail money, and then vanished with huge gains.
While others were losing fortunes.
Exactly. Contrast that with the tragic fate of the late buyers, the everyday investors who lost heavily. One specific, harrowing example highlighted is a trader who tragically lost $500,000 in hours from the YZY crash.
$500,000.
Right.
Just gone.
Gone.
Yeah.
In hours. These aren't small losses. These are potentially life-altering sums. So what does this say about those anti-sniping measures? Were they a genuine attempt at fairness that failed? Or a deliberate diversion, a performance to hide the manipulation?
The evidence seems pretty clear.
The evidence, the swift, huge profits for insiders at the direct expense of ordinary investors, strongly suggests a calculated strategy, not an accidental failure. It completely undermines any claim of a fair launch, reveals it as an elaborate yet ultimately transparent scheme.
It certainly paints a pretty grim picture, almost a predictable playbook. Unfortunately, YZY isn't an isolated case, is it? It seems to follow a familiar, deeply troubling pattern we've seen before, especially when celebrities lend their names or even just notoriety to these ventures.
You're absolutely right. What's really concerning is how YZY perfectly follows the controversial pattern of celebrity coins. This isn't new. We've seen it play out time and again.
Like which ones?
Think of Trump's Trump token, or the tokens associated with the Kardashians, even Akon's a coin. The common thread is remarkably consistent. They are sudden eruptions built almost entirely on hype.
Leveraging the name.
Exactly. Leveraging the celebrity's brand, their social media reach, their fan base, rather than any genuine tech utility or viable long-term model. They tap into this fervent, almost cult-like following.
And the result.
Almost inevitably, this initial hype surge, fueled by a powerful name, leads to severe retail investor losses. The core asset being traded isn't really innovation or a service, it's fame itself. Fleeting attention packaged as a token.
Which isn't a stable foundation.
An incredibly poor and volatile foundation for sustainable value. The psychological pull of a celebrity can be so strong it overrides critical thinking, financial prudence, makes people blind to the red flags we've discussed. It's a testament to human irrationality facing the promise of quick riches tied to a familiar face.
This definitely raises a big question about accountability for investors who lost everything. In traditional finance, there are at least some avenues for recourse, right? Lawsuits, regulators, even if imperfect.
Some, yes.
But what about in this relatively unregulated Wild West of meme coins? Our sources point to a particularly concerning detail embedded right in the YZY launch documents.
This, for me, is maybe one of the most alarming and frankly cynical revelations. The YZY launch documents the terms and conditions hardly anyone reads before clicking agree, included a class action waiver.
A class action waiver, what does that mean here?
It's a clause, often buried in legal text, that explicitly states investors give up their right to join a group lawsuit against the project creators. Even if the project goes sideways, even if there's negligence, malpractice, even outright fraud.
So they're saying up front, you can't sue us as a group.
Precisely. The gravity of this can't be overstated. In an unregulated or lightly regulated space like crypto, this clause acts like an ironclad shield for the creators. It absolves them of collective responsibility before anything even goes wrong.
Wow. It explicitly tells investors from the outset, you can't sue, even if the project goes awry. This signals a clear anticipation of potential problems and a preemptive legal move to protect themselves from the fallout.
That's incredibly brazen.
It raises profound ethical and legal questions about intent. When your foundational documents include a mechanism to prevent collective legal action, especially when the project then shows all the signs of a pump and dump, it essentially says, invest at your own risk, and by the way, don't come crying to us when it collapses.
A huge warning sign.
A stark, almost audacious warning sign. It highlights a deliberate attempt to insulate themselves from accountability for the financial devastation they caused.
That's truly unsettling. A deliberate attempt to limit responsibility from the get-go. So what does this all mean for the wider crypto ecosystem? The one trying to mature and gain mainstream acceptance. And maybe more importantly, for you, our listener, trying to make sense of this complex, sometimes treacherous landscape. Yeah, connecting it to the bigger picture. These celebrity-driven, highly speculative token launches, like YZY, serve as potent, expensive warnings. They really underscore why robust regulatory scrutiny, rigorous due diligence by investors, and absolute tokenomic transparency aren't just good ideas, they're essential. Absolutely essential for protecting retail investors.
Because the average person is vulnerable.
Incredibly vulnerable. In an environment where a famous name can generate billions in market cap in hours only for it to vanish just as fast, the average person lacks the sophisticated tools, the on-chain analysis skills, often the understanding of the subtle red flags.
Right.
Without more oversight, without clear expectations of transparency on token distribution, liquidity setups, and without individuals doing their own thorough research looking past the hype to the fundamentals, these scenarios will just keep playing out with devastating consequences.
So understanding is key.
Understanding the why behind these crashes, recognizing the critical red flags we've discussed, concentrated holdings, dodgy liquidity, those insidious class action waivers that empowers you, the learner. It equips you with the knowledge to spot legitimate projects versus speculative traps.
Moves you from potential victim to informed participant.
Exactly. You become informed, cautious, and ultimately a more secure participant in this dynamic. But yes, sometimes dangerous market, your vigilance is your first and best defense.
It's abundantly clear that these patterns, these playbooks, tend to repeat themselves with alarming consistency. Can you give us some specific examples of this pattern playing out with other celebrity-backed tokens? YZY isn't unique, despite its high profile.
Absolutely. One of the most prominent recent parallels is, ironically, with Trump's Trump token. This project, like YZY, showed a remarkably similar hyperlease dynamic. It capitalized on immense public attention, the highly recognizable, often polarizing figure of Donald Trump.
Same playbook.
Very similar. Just like YZY, it saw an initial surge of speculative interest, often driven by political fervor, not tech merit. This led to high insider benefits. Those close to the project or early in the know got significant holdings. Then, predictably, a rapid sell-off once the hype plateaued or waned.
Surge, insider profit, crash.
That's the trajectory. A burst of speculative interest driven by persona, quick gains for insiders, significant losses for latecomers. It really showcases how history tends to repeat in celebrity meme coin launches. The underlying mechanics of leveraging fame for quick profit, often at retail's expense, remain consistently effective in an unregulated space.
It's not just political figures. We've seen examples from entertainment and music, too. Can you talk about those? Maybe Ethereum Max or Acoin? They got a lot of attention before their own collapses.
Indeed. Zooming out further, examples like Ethereum Max and Acoin further solidify this dangerous trend, show its prevalence across different celebrity domains. These were also celebrity-backed tokens that ultimately collapsed despite star endorsements.
Big names involved there, too.
Incredibly high-profile figures. Kim Kardashian, a global influencer, famously promoted Ethereum Max. Akon, the musician, launched a coin with ambitious goals for Africa. In both cases, the immense fame, reach, perceived credibility provided a powerful initial boost, generated huge media attention, drew in lots of unsuspecting investors.
But the fame wasn't enough.
Not even close. Despite the endorsements and buzz, these tokens failed to sustain value, failed to deliver on their promises, leading to collapse. The crucial takeaway here, and we can't stress this enough for you listening, is that fame doesn't equate to value or safety in crypto.
It just fuels speculation.
Exactly. A celebrity endorsement acts as a magnet for attention and capital, but it absolutely does not and cannot provide fundamental strength, utility, tech robustness, or financial stability. In fact, it often signals the opposite reliance on marketing and personality over solid foundations.
So the endorsement itself can be a red flag sometimes.
It certainly warrants extra scrutiny. These examples are stark reminders. A recognizable face is no substitute for rigorous due diligence.
So given all these recurring patterns and the sheer volume of these speculative launches, is this solely a celebrity issue? Or is it also part of a wider trend on certain blockchains, particularly Solana, where YZY specifically launched?
That's an important question. It's crucial to see the broader context, beyond just celebrity influence. While celebrity involvement definitely amplifies the effect, YZY's fate also resembles prior frenzies on Solana launchpads and within the wider meme coin ecosystem.
Solana seems to be a hotspot for this.
Solana, known for its high speed, fast transactions, low fees. Unfortunately, it's become fertile ground, almost a breeding pool, for these highly speculative meme coins. Its tech makes it attractive for developers wanting to deploy tokens quickly, cheaply, and for traders looking to capitalize on rapid price swings.
Low friction means more launches, good and bad.
Precisely. We've seen numerous instances where token hype creates temporary mania followed by crashes on Solana, even without direct celebrity involvement. Often community-driven meme coins surging on viral trends or internet culture.
So YZY fits into a bigger Solana picture too.
Yeah, YZY, while having a celebrity core, also echoes the wider meme coin ecosystem risk that's particularly prevalent on networks like Solana. It's a confluence of factors. The pull of celebrity, speculative market conditions chasing the next big thing, and a high-performance blockchain facilitating rapid, often unregulated launches.
A perfect storm.
The perfect storm, creating an environment where projects like YZY can explode onto the scene and then implode just as quickly, leaving that trail of immense profits for a few and widespread losses for many. It's a systemic risk within this specific crypto niche.
Given all this intricate data, the on-chain stuff, insider activity, the volatility, if we were to visualize what happened with YZY, what would we actually see? What charts would really drive home the story of its rise and fall? Illustrate the mechanics for someone trying to grasp it.
To really grasp the savage and swift nature, you'd immediately look at a YZY price and market cap slide. Imagine a dramatic line graph. Starts almost flat, right? Humble beginnings. Then boom, the line shoots straight up, almost vertical, to that $3 billion peak. Astonishing ascent.
Like a rocket.
Exactly. But then, just as abruptly, maybe even faster, it plunges downwards, nearly straight back to the start or lower, all within hours. This visual plot would show how sudden and devastating the shift was, underscore the speed, almost no time for ordinary investors to react or exit before the value was gone.
Like falling off a cliff.
Precisely. The line wouldn't just fall, it looked like it was cut. A classic pump and dump signature. The momentum and volume at the peak, contrasted with the evaporation, highlights the fleeting nature of the bubble.
That's a powerful image of destruction. And what about the underlying control we discussed, the insider's iron grip on the tokens? How would that look visually to really emphasize the power imbalance?
For that, you'd want a supply concentration heat map or maybe a really stark pie chart. Picture a visual where one massive segment, like 94% of the whole pie, is colored distinctly, maybe a deep, ominous red labeled insiders.
Dominating the chart.
Completely. The remaining sliver, a tiny 6%, maybe in a muted, vulnerable color, labeled public. This visual immediately, unequivocally spotlights the structural risk, makes the power imbalance undeniable, shows the public market was just a stage for insiders, not a real arena for exchange.
Makes it clear why price discovery was impossible.
Exactly. It shows volumes about why genuine participation was impossible. Shows a market designed for extraction, not growth.
So if we then zoomed in on the trading itself, that problematic liquidity pool setup, how would we visualize that to explain its manipulability, the trap it created?
A liquidity pool breakdown graphic would be essential. You'd illustrate a standard healthy pool first, two balanced sides, maybe YZY tokens and USDC, showing a stable two-way exchange. Represents a fair marketplace.
The ideal scenario.
Right. Then you contrast that sharply with the actual YZY pool, depicted as a single overflowing tub of YZY tokens, maybe paired with only a tiny illiquid amount of another volatile asset like Solana, but crucially, no stablecoin counterpart.
Visually showing the imbalance.
Clearly showing how single-sided pools function and why they're ripe for manipulation. Graphically demonstrates the lack of a balanced exit route for retail. Highlights how money could flow in to buy YZY, but there was no equally accessible, stable way to flow out with reliable value. It's a visual metaphor for a one-way valve.
Where insiders could drain the value.
Easily drain out valuable assets like the Solana new buyers use without providing a stable exit for those new buyers holding YZY. It's a funnel for profit extraction, visually clear.
And to really underscore the human cost, the stark difference between the winners and losers, what visualization brings that home?
To drive home the unequal outcomes, the human impact, you'd need trader loss highlights, presented compellingly. Imagine data points or small bar graphs. On one side, stark red bars. Specific examples of big whale losses, like that trader losing $500,000 in under 2 hours.
Devastating numbers.
The size and speed immediately apparent. And crucially, juxtapose this with green bars, visually contrasting profits made by insiders, maybe multiple much larger green bars showing the millions pulled out in minutes or hours.
Winners versus losers, side by side.
Makes it abundantly clear, starkly illustrating the massive wealth transfer from uninformed retail, fueled by hype, to well-positioned, often pre-informed insiders, an undeniable picture of a rigged game.
Finally, to bring it all together, reinforce the systemic pattern. How would we effectively compare YZY to other celebrity token flops? Draw out the common threads for our listener.
You'd want a comparison with other celebrity token flops table or infographic, concise but powerful, laying out launch, crash, and investor outcomes from YZY, Trump, ETHMax, etc. side by side.
A clear comparison.
Imagine columns. Celebrity involved, initial market cap, percentage drop, typical investor outcome, seeing the similar crash percentages, recurring themes, initial hype, high insider control, bad liquidity, rapid value destruction across multiple high-profile projects would be incredibly impactful.
Reinforces the pattern.
Visually reinforces these aren't isolated incidents, but recurring, predictable patterns when celebrity meets speculative, unregulated markets. Allows you, the listener, to quickly spot the unmistakable hallmarks of these dangerous schemes in the future. The lessons become graphically undeniable.
So as we wrap up this incredibly detailed deep dive into the YZY crash, peeling back the hype, exposing the mechanics, what are the most crucial, actionable lessons for you, our listener, to take away? What's the bottom line here?
Okay, the primary paramount takeaway is this. Celebrity hype is powerful, almost intoxicating in crypto, but it's overwhelmingly often deeply deceptive. Always, always prioritize rigorous fundamental analysis over any celebrity endorsement, no matter how famous. A name doesn't confer value or
You
safety.
don't trust the hype.
Don't trust the hype. Second, develop a critical eye for tokenomics, especially supply distribution and liquidity pool setups. High insider concentration, that 94% with YZY, and single-sided pools with no stablecoin pairing. Not just red flags, they're screaming sirens. Run the other way. They're structural designs for exploitation.
Got it. Check the structure.
Third, be extremely wary of projects with class action waivers, or that explicitly try to absolve themselves of responsibility upfront in the terms. It's a clear, cynical indicator they anticipate problems and are shielding themselves from accountability. A sign of bad faith.
Look for those waivers.
And finally, internalize this. Extreme volatility and the very real potential for rapid total loss are inherent risks in highly speculative meme coins. Never, ever invest more than you can comfortably afford to lose. Approach anything driven purely by fleeting hype with intense skepticism and analysis. Your financial security depends on it.
That's incredibly vital, sobering advice, insights that can genuinely protect you, our listeners. And that leads me to a provocative thought for you to reflect on, maybe mull over long after this deep dive. If insiders can orchestrate these schemes, pull millions in minutes, leaving everyday traders with heavy, life-altering losses, and as we've discussed, often with no legal recourse, what truly defines a fair or accessible market in crypto?
That's a deep question.
And what role, if any, should regulation play when the consequences for ordinary people, those swept up in the hype, are so severe, so devastating? It's a question worth pondering as this space keeps evolving so rapidly, often unpredictably.
Definitely food for thought.
If you found this deep dive into Kanye's YZY token crash helpful, and you want to keep gaining insights like these insights that, cut through the noise, expose the mechanics, get to the real story, please remember that subscribing, commenting, engaging with the video, it really helps support the channel.
It absolutely does.
It boosts our visibility in the algorithm, lets us reach more curious learners like you, and lets us keep creating this quality crypto content. We genuinely love hearing your thoughts, your questions, your own experiences based on these deep dives, so please share them in the comments below.
Yeah, let us know what you think.
Until next time, stay curious, stay informed, and most importantly, stay vigilant.